วัสดีค่ะทุกท่านได้เวลาของการนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะหรือ PSL โดยคุณคาริน ฮาชิมกรรมการผู้จัดการของเราจะนำเสนอข้อมูลในเรื่องของภาพรวมของอุตสาหกรรมและตามด้วยคุณก่อตั้งอุรานากรรมการทางด้านการเงินจะพูดถึงเรื่องของตัวเลขทางการเงินนะคะและในช่วงสุดท้ายเป็นช่วงคำถามคำตอบนั้นถ้าท่านใดมีคำถามก็สามารถที่จะพิมพ์เข้ามาทางในระบบได้เลยนะคะขอบคุณค่ะเดี๋ยวขอเชิญคุณคารินนะคะ
Thank you, Chong. We will do the presentation in two halves. I will take the industry structure first, and Gautam will take over the finances of the company. So if you're looking at the performance of China in the first quarter of 2024, you can see that China has had a stellar performance, 5.4% up in iron ore imports, 14% up in coal imports. If you look at steel exports, up by 30% almost, and steel consumption was slightly down by 4.7%. If you look at the property sector, which is what everyone talks about, then in the last 30 years, China has built about 14.4 billion square meters of saleable homes. And the per capita urban space is 38.6 square meters. That means 14.4 billion square meters, which has been built up, can house 370 million people, just 40% of its current urban population of 920 million. So therefore, all the stories in the Western media about wholesale extra built homes in China is not necessarily supported by the facts. The main characteristics when there is significant oversupply are as follows. If there's a prolonged contraction in transactions of resale homes, however, in China in 2023, resales of homes went up by 44% in floor space terms. So that is not present anymore. Secondly, if the property development represents more than 7% of GDP, then it is a problem for the sector. In China, this ratio hit 12% in 2013, but is expected to be just 5.5% in 2024. Therefore, we think, based on these statistics, that China's property has passed the inflection point, and going forward, it should grow reasonably well. At the end of 2023, the home price index had slipped by 9% from its 2021 peak. This has created a negative wealth, and therefore it has dampened consumption and slowed the economy from an investment-led to consumption-driven economy. China is on track to increase its urbanization from 65% to 73% by 2035. This will add 100 million more to the urban population, and all will require housing. So latent demand for housing is substantial. Now, many people also keep saying that the housing sector woes will lead to a financial crisis. So here we are examining whether this is factual or not. So first factor is the average loan-to-value ratio of home mortgages in China. Major cities, it is about 50%. And home loans have an unlimited liability on the persons who are mortgaging their properties to the banks, and therefore defaults are very, very, very low in China and remain below 1%. Banks' exposures to developers is less than 5% of their loan book. Banks are extremely well capitalized at more than 15% capital adequacy ratio, and their average NPL ratio is about 1.6%. Regulatory requirements for banks is that they must cover NPLs in the real estate sector at more than 100%. Therefore, it makes no sense for banks to hold such loans, and they normally would sell it off immediately. The housing crisis continues to retard the economic recovery. The property sector reduced GDP growth by 4% in 2022, 1.3% in 2023, and is expected to only reduce the economic growth by 0.9% in 2024. Once again, this trend tells us that the inflection point in the property sector should be reached sometime during this year. Bankruptcies in the property companies has quintupled from 123 in 2022 to 590 in 2023. But household bank deposits increased by $2.5 trillion in 2022 and a further $2.36 trillion in 2023. In the US, residential properties represent almost 25% of household wealth. But in China, it represents almost 60% of household wealth. Therefore, you can understand why the Chinese economy has slowed down over the last 3-4 years, ever since 2013, when the property sector reached a high level of development of the GDP at almost 13%. If you look at the iron ore and steel demand during 2023, what do you see? First of all, you see that China hit a 7-year high in terms of exports of steel, which went up by 35%. If you look at the Chinese steel demand for real estate and infrastructure, it was supposed to slow down by 4.8%, but infrastructure went up and offset this expected decline, and it was much less than that because the infrastructure sector grew by 3%. If you look at the steel demand during 2023, it was supported by shipbuilding, by automotive cars, and energy sector. If you look at the decline in steel consumption, Chinese iron ore imports still increased by 6.6%. So therefore, you could almost say that iron ore imports and steel consumption in China are not linked to each other. Reuters further says that iron ore growth could be driven by lifting of the government steel output cap policy and lower steel scrap availability for producing steel. Both these factors would play a significant role. Financial Times cited explanations for growth of iron ore, such as infrastructure stimulus plan driving iron ore restocking and iron ore prices appearing cheaper due to stronger yuan, making the imports of iron ore more attractive proposition. Now, this slide explains what's been happening over the last 5 years. So if you take the average steel consumption over the last 5 years, it was 953 million metric tons per annum in China. 2023, it went up to 971 million metric tons, or plus 2%. So on a historical basis, China is consuming more steel than the 5-year average. This slide tells you how Clarksons is looking at China's economy and seaborne trade outlook for 2024. So what is Clarksons saying? They're saying that the record-breaking seaborne trade growth in 2023 slowed down during the second half of the year and is expected to slow down or be moderate, expected to have moderate growth in 2024, with imports remaining flat whilst exports would grow moderately. Clarksons expects slowing iron ore and coal imports, but rising grain and bauxite imports in 2024. China is increasing energy trade with Russia. It's diversifying its grain imports from Brazil, Australia, Canada, and Africa, and its container exports to Russia and emerging markets like the Middle East, Indian subcontinent, Africa, and Latin America is increasing. If you look at the disruptions in the Red Sea and the Panama Canal, they are having a big impact on China's container exports. If you look at the stimulus that is expected from China, it's not going to be dramatic. It's going to be high quality growth driven rather than rapid growth driven. If you look at the property sector, it still remains under risk and consumer sentiment remains cautious because a lot of their wealth is locked up in the housing sector. And housing sector volatility in the stock market is constraining consumer spending. So if the property sector turns around, as I've shown you the data on it, during 2024, you'll find that consumer spending will start to increase. Chinese GDP growth forecast is somewhere between 4.5% and 5%. The Chinese government and the IMF estimated to be 5% and 4.6%. So it looks quite reasonable. If you look at India's performance, it has been outstanding again. Iron ore exports were up by 44.2%. If you look at coal imports, it was up by 7%. If you look at steel production, it was up by 19%. If you look at the steel consumption, it was up by 19%. So overall, you can say that India is doing really well. If you look at the total dry bulk trade in billion ton miles, what do you see for 2024? You see that it's going to grow by 2.37%, and for 2025 is forecast at 1.14%. At the same time, forecast of growth of tonnage for 2024 is at 2.9%, and for growth in tonnage in 2025 is 2.3%. And these are all Clarkson's numbers. If you just look at minor bulk, you can see that it's going to grow by a strong 4.52% this year, against a growth in the smaller sector of ships at 4.2%. And in 2025, this growth will moderate to almost 3%, with the growth in supply of ships in the geared sector at 3.3%. If you look at Clarkson's forecasts as an example and look at trade growth in billion ton miles, you would see that in January 2023 for 2024, they were expecting an overall growth of 2.02% and growth in the minor bulks at 2.82%. And if you look at their latest edition for 2024 in March, what have they saying? They're saying that overall growth will grow by 2.37% and growth in minor bulks will grow by 4.52%. So a big change from what they were forecasting 1 year ago. If you look at fleet growth, it's the same story. In January 2023, they were forecasting a total fleet growth of 0.3%, and in the smaller sector of 0.6% in January 2023 for 2024. And look at the March edition. It says that overall fleet growth will be 2.9% and growth in the smaller geared sector will be 4.2%. So keep in mind that Clarksons are getting everything wrong. They're getting wrong the demand side as well as the supply side. If you look at what type of cargoes are carried, you can see that our sector of ships is predominantly carrying minor bulks, 55% in supras and ultras, and 67% in the handy size. If you look at the total growth in tonnage during the first quarter of this year, you can see that the total growth in absolute deadweight ton terms was 3.73 million deadweight tons in the geared sector, and in the gearless sector or the bigger ships, it was at 5.67%. So you can see absolute number wise, the bigger ships are growing faster than the smaller ships. If you look at the order book, the forward order book as of the 1st of April of this year was 87.11 million deadweight tons, or 8.66% of the existing fleet. So again, the forward order book, and if you compare that, for example, with the 20-year-old fleet, the forward order book is less than the existing 20-year-old fleet. If you took the 20-year-old fleet to the same date as which the forward order book is taken to, that is the end of 2027, you would see that it would be 16.16%, almost double of the order book which is there currently. Now, the thing to notice here is that the peak of the order book was in 2009 at almost 80%. If you look at the confirmed, okay, so we've already gone, sorry. If you look at the period of time of 2003 to 2009, compare that with 11 years between 2010 and 2020, then the next 2 years, 21, 22, then 2023, and then 2024, you could look at, say, for example, the annual demand figures. That was growing by 5.4% during this period of time, dropped to 4.3%. And in 2021, 2022, when we had significantly higher rates, it was only at 1.2%. And then in 2023, when the demand grew by 4.83%, we had a reasonably slow year. It was profitable, but slow. And now when you see 2024, the forecast 2.37%, we find that the numbers have all grown sharply upwards. If you look at the overall supply that was being created during this period of time, It was 6.8% per annum during 2003 to 2009 every year. It was at 6.4% for 11 strong years. And then it dropped to 3.3% in 2021 and 2022, and was down to 3.1% in 2023, and is now forecast to be at 2.9% during this year. The main thing to remember is that as of the 1st of April, the 20-year-old fleet was at 8.7%. If you just looked at it on this year, versus 8.66% as the forward order book, which is all the way to the end of 2027. But if you were to look at end of 2027 and assume no scrapping, then this number would have risen to almost double this number at almost 17%. Average speed, if you look at that, it's been dropping. If you look at the congestion numbers, they're dropping, but now starting to rise again in the first quarter of 2024. If you look at what's happening to net supply growth, including congestion, then you would see that if you had congestion, which was prevailing pre-COVID levels, then this would be the annual growth in supply. And if you had congestion, if you had congestion, which was at the 2023 level, then this would be what would be the supply side. Now, there are three reasons why there have not been more new ship orders. The first is, of course, we were crowded out. That means LNG, container ships, car carriers, gas, and tanker ships have booked all available slots before dry bulk could get their act in order and start ordering ships. Secondly, capacity is still below the peak. Thirdly, there is this transition of fuel taking place, and therefore people are worried to order fuel-burning ships. So the slide on the industry takeaway is as follows. IMF estimates GDP growth of 3.2% in 2024. They forecast US GDP growth to be 2.7% in 2024, higher than the 2.5% in 2023, and 0.6% above their forecast of 3 months ago. GDP growth of 3.2% is forecast in 2025 by the IMF. China's GDP growth in 2023 was 5.2%, and the Chinese government forecast for 2024 is 5%, and in quarter one, China grew their GDP by 5.3%. In terms of ton-mile demand growth, Clarkson's forecast 4.37% in 2023, largely driven by China's economic recovery. Steel consumption in China was marginally negative, but it was supported by shipyards, EV makers, infrastructure, and steel exports. China's fixed asset investments was up by 3% during 2023, and consumer spending has rebounded, though it is not rebounded as strongly as people expected it to. As I said, consumers were saving more money rather than spending money because of the negative wealth impact from the slowdown in the housing sector and from the volatility in the stock market. If you look at dry bulk supply, Clarkson's is forecasting 3.1% in 2023 and to grow by 2.9% in 2024. But net supply will be further reduced because of the lower speeds due to compliance with EEXI and CII regulations, somewhere between 1.5% and 2%. The forward order book ratio at 8.66% is below the 20-year-old fleet at 8.7% as of the 1st of April. Low water because of the climate change, low water at Panama Canal, disruption at Suez Canal, and congestion at South and North American grain ports. Climate change, extreme weather events have resulted in disruptions and increased ton-mile delays at sea and congestion, and have pushed rates up. Supply-demand balance continues to improve. So what have we been doing? We have been trying to sell our older ships and buy younger ships. So as a result, you can see that the average age was 12 years at the end of December 2023. At the start of March 2024, because we sold one older ship, it remained at 12 years. And on the 16th of April, when we took delivery of one younger ship, the average age dropped to 11.9 years. This is what we expect to continue to happen as we sell older ships and replace them with younger second-hand ships. If you look at the average deadweight, As of the end of December, it was 43,621. When we sold one smaller ship and replaced it with one younger ship, we found that this number went up first to 44,000 and then is almost 44,000 again. If you look at the comparison between us and the standard handy size index ship, you can see that we were below them in earning terms by 5.54%. But remember, the standard size ship in the handy size index is the 38,000 tonner versus our 31,000 tonner. Similarly, for the Supramax and Ultramax index, we were up by 6.43%, even though our ships consume more oil than the standard ship. If you look at our forward 4-year rolling book, it shows you what is the earnings per day per ship that we've already locked in. And this shows you the percentage, and this shows you the number of days locked in each of those years. And with that, I've ended the industry section, and Gautam will take over the financials of the.
Thank you, Khalid. So here are the highlights for Q1. So in this quarter, in the first quarter, we reported a net profit of 409 million baht, or about USD 11.39 million baht, or 0.26 baht per share. Our EBITDA was 725 million baht, or USD 20.18 million. We declared an interim dividend number 4. This is for the fourth quarter of 2023, and this was in the amount of 5 satang, and it was paid on the 11th of March of this year. We further declared a final dividend of 5 satang, and this was paid on 3rd of May 2024. So in terms of financing during the quarter, we entered into a USD 25.5 million credit facility agreement with the Export-Import Bank of Thailand. This was signed on the 8th of March of this year. We disposed of 2 ships. So the first was the Ratana Nari. This is a 2002 built handy-size vessel. This is the oldest vessel in our fleet, and she was delivered to her new buyers on the 15th of March. And we also sold the 2013 built Supramax Vikanda Nari, and this was delivered to buyers on the 16th of April 2024. We also acquired a young fuel-efficient handy-size bulk carrier, about 40,000 deadweight. We've called her Hansa Nari, and we took delivery of this vessel on the 11th of April of this year. So at the end of the quarter, we had 5 ships on long-term time charter contracts at fixed rates, and we had another 15 that were on long-term time charter contracts at levels linked to the underlying index for vessels of that size. So most of the index-linked charters are for 1-year duration, 1 year, or in some cases slightly longer. So some key figures for Q1 compared to Q4 of last year. So our revenues in Q1 came in at 44 million compared to 40.6 million in Q4 last year. This is all in US dollars. The net profit for the quarter was 11.4 million compared to 7 million in Q4. The earnings per share was 0.26 baht compared to 0.16 baht in Q4. The return on equity was 7.6% compared to 3.99% in Q4. And our debt continued to come down. Our net debt to equity ratio was 0.28 compared to 0.31 at the end of Q4 2023. The number of ships declined from 38 to 37 at the end of the first quarter. So this graph, the top left, we show you the average time charter rate per ship per day over the last 5 quarters, and you will see that Q1 of 2024 was in fact the strongest quarter that we've had in the last 5 quarters. The rate was 12,000. The average TC rate per ship per day was 12,433. EBITDA That's the top right graph. That's EBITDA for the quarter came in at 20 million, just shy of 21, in fact. We've been paying out dividends consistently, as is evident from the graph in the bottom left. And our cash balance remains quite healthy. At the end of Q1, our cash balance was about $46 million. This is our statement of financial position. So our picture of our balance sheet. So you'll see that at the end of Q1, our vessels and equipment stood at 597 million compared to 609 million at the end of last year. And this is the reduction is partly because of depreciation, but also partly because of the sale of one vessel, the Ratana Nari, which we disposed of in the first quarter. Shareholders' equity was up from 475 million to 484 million. And loans were down from 214 million to 179 million at the end of the quarter. Cash was slightly down as well from 68 million to 46 million. So this is the cash movement in the first quarter. So we started the quarter with 68 million of cash. We generated 23 million of cash from operations. CapEx, which is mainly comprising dry dock related expenses, that stood at 6 million. We had about 7 million of cash generated from the sale of the Ratana. And interest costs were about 5 million. And we prepaid one loan, and also, of course, repayments of loan also took place during the quarter. So in total, repayments and prepayments totaled 35 million. We paid dividends of about 2 million, and we entered the quarter with 46 million. So this graph shows you a breakdown of our operating expenses. We show you the figures for Q4 2023 and Q1 2024. So the main differences are in terms of crew costs. So crew costs in Q1 were somewhat higher because of additional expenses related to the sale of one of the ships that we had. Otherwise, stores and spares were slightly down. And otherwise, operating expenses on the whole were fairly stable. We ended the quarter Q1 2024 at 5,379. This graph over here shows you our operating expenses compared to the industry average. And you'll note that in the latest year, our average operating expenses coming at 4,613 compared to about almost 5,000 for the industry average. So we are roughly about $400 lower than the industry average. That translates to about $4 million on the bottom line. I should mention that the difference in our lower operating costs are not as a result of crew costs, which are actually in line with the industry average, but we have lower other costs, so lower insurance costs, lower other miscellaneous expenses, and that contributes to a lower average cost compared to the industry. Okay, so over here we've compared our OPEX and G&A to 4 other listed companies that are also in the Supramax and Ultramax sector. So this is data for 2023. So you'll see that in terms of OPEX and G&A. So first of all, in terms of G&A, we are actually the lowest among all our peers. In terms of OPEX, we are the second lowest. And then you translate that into an EBITDA per ship figure by looking at also the revenues that you generate, and you'll see that we are generally consistently up there in terms of the last 12 months EBITDA per ship. One of our peers has some very strong charters from historical charters that they're benefiting from. And that's why they're higher than us on a EBITDA per ship basis. But usually we are we outperform most of our peers when it comes to an EBITDA per ship basis, because we also, as we have showed you previously, we tend to outperform also on the revenue side. We tend to beat what the index is. Okay, so this is the debt maturity profile. So you'll see we've continued to try to stretch out the maturity of our loans, lower the interest costs. So we had prepayments, as I talked about. We had some prepayments in the first quarter of the year. We've also signed some new loans with longer maturities in line with that strategy. That's something we did last year as well. This shows you our net debt and net debt to equity ratio over time. So you'll see that our net debt peaked in 2017. This is when we had just finished taking delivery of all the new building ships that we had ordered and had delivered to us in the previous 6-7 years. Since then, our debt has been coming down, and currently our net debt is at a very, very low level of 133 million, and the net debt to equity ratio is also at a very, very low level, slightly less than 0.3. Okay, over here we show you our average OPEX and the TC rate. So this top line over here shows you the average age of ships in our fleet. So you'll see that from the year 2000 until about 2011, our fleet was fairly elderly. Thereafter, we embarked on a program to order new ships, and those new ships started to get delivered from 2012, whereafter the average age of our fleet reduced. It was at its lowest level in 2016 at 5.8. Since then, it's been creeping up, but of course, we have, as Khalid just mentioned, we have been making efforts to renew our fleet, to replace some of our older ships with younger vessels. So therefore, you've seen that not creep up as yet. This red line shows you the average size of ships in our fleet. So in the year 2000, the average ship in our fleet was 22,000 deadweight, and then we upsized that in line with the needs of our primary customers. And now the average size of ships in our fleet is about 44,000 deadweight. This dark green line over here shows you the average time charter rate per ship per day. So you'll see it was at 5,760 back in the year 2000. And then China joined the WTO. There was a big boom, dry bulk boom as a result of that. And we had a couple of years of very strong years. But of course, while demand was strong, the supply was even stronger, was even greater, and all the ships that were ordered from 2005 until 2008 or 9, they started to get delivered from 2008-9 onwards, right until 2016, and this caused a decline in the average rates earned by ships, the global dry bulk fleet. After that, these supply pressures have abated. And so you've seen rates move up, although of course it's been volatile because of COVID and other reasons. Rates have been moving up on improved demand supply fundamentals. This line over here shows you the average operating expense for our fleet, which is fairly stable, save for the COVID years when global inflation did impact operating expenses for our fleet as well. But of course, those inflation pressures have begun to abate, and therefore the operating expenses are not of late increasing by the same degree. This over here shows you the dividends that we have paid over time. So our policy is to pay not less than 25% of net profit as a dividend. So you'll see generally we pay more than 25%. Of course, there was a period when we did not pay dividends from 2014 until 2021 when dry bulk markets were extremely weak. We have, of course, resumed paying dividends, and the ratio, the dividend yield is also much higher than our minimum policy. So this is a lot of figures, but I'll just quickly highlight. So our net profit, excluding non-recurring items, and the non-recurring items are essentially the gain on sale of vessel, that we talked about. So there was a gain on sale of that one vessel of 1.42 million. There was a gain on derivatives of 0.25 million, and there was an exchange gain of 0.57 million. So after you account for those non-recurring items, the net profit for the quarter Q1 was 9.1 million, which is quite similar actually to what it was in Q4 2023. And you'll see that the average TC income per ship per day was also quite similar for both quarters, for Q1 as well as Q4. So this is provided as a reference. I'm not going to go through these figures. But just to highlight, this is so we went public. We did our IPO in the year 1993. If you are an investor in our IPO and if you reinvested all the dividends you received from us back in PSL stock, you would have earned a 15.74% compounded return on your investment. Why do we bring this up? It's because dry bulk companies, many of them have given the industry somewhat of a bad name. So there was an article published by an online publication called Splash 24/7, which looked at the returns since IPO of dry bulk companies. Now, all these dry bulk companies listed in US markets, and you'll see that in all cases, dry bulk companies that listed in the US lost money for their investors. But I'm very happy to say that's not the case for us. So if you were an investor, if you had invested 10,000 baht in 1993 in PSL stock, it would be worth about 966,000 baht as of April 2024. Assuming, of course, that all dividends are reinvested into PSL stock. Okay, so there are some data on investor relations. Just on ESG. So we were one of 16 companies in Thailand that was recognized as an outstanding climate action leading organization by the Thai government for our commitment to greenhouse gas management. We received an award from the Deputy Prime Minister of Thailand for this. We were awarded carbon neutral certification by the Thailand Greenhouse Gas Management Organization, and we were awarded this. We achieved this accolade by entirely offsetting our Scope 1 and Scope 2 emissions for the year 2022 through our support of a renewable energy project. I expect we will receive similar carbon neutral certification for the year 2023 as well, as we have again this year. We have committed to offsetting our entire Scope 1 and Scope 2 emissions by supporting the same, actually, renewable energy project. We were also awarded the Carbon Footprint for Organization certification by TGO, again, acknowledging our comprehensive carbon reporting practices. We are very committed to reducing our environmental impact. And so if you look from the year 2014, our carbon ton emissions per ton mile were 12.884, and in the latest year, 2023, it's at 6.8. And so we did this by, first of all, selling off our older, less fuel-efficient ships and replacing them with eco vessels. We also did this by retrofitting our fleet with various fuel-saving devices, such as Mavis ducts, pre-shrouded vanes, hub vortex, absorb fins. So we're quite unique in the dry bulk industry also, because we have a environmental policy statement. We've had this since the year 2009, based on ISO 14,000, initially based on ISO 14,001-2004 standards, and then this was updated to ISO 14,001-2015 standards. We're a founding member of the Getting to Zero Coalition. We continue to support the Michai Patana School this is a school in Buriram province. We continue to provide scholarships to the students at the Merchant Marine Training Center. We provide about 42 scholarships each year. We also provide academic and need-based scholarships to younger students, high school students, middle school students. I'm going to go through this quickly because I realize we have questions from investors. So we are In 2022 and 2023, we were part of the Thailand Sustainability Investment List. We won the Best Investor Relations Award for companies with a market cap of between 10 and 30 billion at the SD Award ceremony in 2023. We've been awarded excellent corporate governance for 14 years, for 14 consecutive years from 2010 to 2023. We were the highest ranked global dry bulk shipping company in S&P's corporate sustainability assessment ranking. So that's essentially an ESG ranking. This is 2021. We didn't have a similar ranking for 2022, but we were in the top 12 percentile of global listed transportation companies. And we're also a member of Thailand's private sector coalition, collective action coalition against corruption since August 2019. With that, we are open for questions.
Yeah, so I'll just go through the questions quickly. In the first question is, if China starts to gradually recover, especially in the property sector, will the company benefit since our fleets rely more on minor bulk and grades instead of iron ore? Yes, the answer is yes, we will stand to benefit. What are the reasons? Second question, what are the reasons that Clarksons forecast minor dry bulk trade to grow more than total dry bulk trade? What drives demand for minor bulk and grades? So this is mainly on an expansion of the population base in the world, point one, expansion of the urbanization of people in the world. These two factors rely and create a demand much more for minor bulks than for major bulk. And so for iron ore and coal is not as important as minor bulk and grades for population growth and for urbanization. Third question is, how flexible is shipyard capacity to increase and could cause unexpected additional supply for total fleet growth? Now, this is a question which has been answered in the sense that we have shown you how Clarksons are getting the forecast wrong. And that is because shipyards are able to produce more ships, A, because they become more efficient, B, because they are taking over the assets of some of the shipyards that have gone bankrupt in the past and closed down, and they're absorbing that capacity within their own system. Will it make a big difference in the future? I don't think so. It has changed the forecast from a very low 0.2% of total growth for this year to now about 3.1%. So yes, it has grown quite substantially. If you look at the initial forecast, which was made in January 2023 for the supply coming in 2024. But now there is not much change which will take place in the supply in 2024. So we think that the forward supply book, forward order book, as a percentage of the existing fleet as of the 1st of April is not significant. The next question is that which second-hand ship prices is up so much. Does this have an impact on rising freight rates for the company or vice versa? Sometimes the price of second-hand ships will not necessarily reflect the earning capacity of those ships. And this is one of those times. And the reason for that is that the value of new building prices has gone up quite sharply. Point one, because not enough capacity available for us, because dry bulk was very late in ordering new ships. And the second factor is that the market expects that second-hand ships and new building ships will earn a lot of money in the future. That is the expectation of the market. And because of that, their prices are not coming down. How many more ships will the company keep selling this year if the current price stands till the year end? And when will the new ships arrive? So far we have sold 2 ships. One ship, we have booked the profit of that in the first quarter. The second ship, we will book whatever profit or loss will come in the second quarter. We've already replaced the first ship with a new building, a much younger ship in the second quarter. We think we will try our best to replace every ship that we sell with a second-hand purchase in the market or placing a new building order if we can get a slot at a reasonable price. How many more ships? Okay. Then the next question is, the sale of 2 ships has already been booked in quarter 1? No. One has been booked in quarter 1 and one will be booked in quarter 2. Then how is the freight rate in second quarter 2024 up until today and still showing signs of strength quarter? Okay, we are not talking about our ships now. We're talking about the index ships. If you look at the index ships, they have done better in Q2 than they've done so far in Q1. Anyway, Q1 is always the lowest quarter, but this year has been a fairly strong quarter. As you can see from the presentation that Gautam made, that Q1 earnings were almost identical to Q4 earnings. That means we're earning at almost the peak level of the year already in quarter one. Now, if the normal traditional pattern holds good, then what should you see? You should see Q1 as being the slowest or the lowest quarter, Q2 being higher than that, Q3 falling down a little bit, and towards the middle of Q3 going up sharply up to the middle of Q4, then again coming down. That's the normal pattern. If that pattern holds, you can take the Q1 base and extrapolate on that. Then the average ship running cost in second quarter compared with quarter on quarter and year on year. We can only give you these numbers after the quarter is over, not before that. Will percent of long-term contracts increase this year if freight rates continue its momentum? Yes, it will increase. We are normally doing index-linked charters. We will continue to do that. We will also do some fixed-priced contracts. And of course, if the index continues to improve, we will do very well with our index-linked charters. A percentage of fleet over 20 years of age at end 2027 reached 16.16%. What would be the expected average age of fleet at the end of 2027? I don't have that statistic, but if you contact us directly, we can give you that statistic in less than 24 hours. Given this rise from current average age at 12 years, what would be the required capital expenditure over the next 3 years? Again, it depends on the price of ships. So we really can't forecast what is going to happen in terms of the capital expansion program. The next question, as industry professionals, where do you see the BDR going in the near to medium term? It is a given. Nobody has had a crystal ball. Okay, so nobody has a crystal ball. That's a fact. Nobody knows exactly what's going to happen. That's also a fact. Now, for us, we don't give forward-looking statements. Therefore, for us to make some sort of forecast of where the BDI is heading would be difficult. But if you listen to what I just told you about the normal seasonal pattern of trading rates in the year, Q1 is the lowest quarter to begin with. Quarter 2 goes up. Quarter 3 comes down a little bit to begin with. But in the second half of quarter 3, it goes up quite sharply into the middle of quarter 4. Then again, it falls quite smoothly, going down all the way to the end of Chinese New Year. That's the normal trade pattern. If that holds, then you can extrapolate from what you see in quarter 1. Okay, so I think we have run out of time now. There's nothing else that we can answer you. The balance 2 questions are there. We will be happy to take them. Whoever asked the last 2 questions, we can take them and whenever you send it to us, and we can speak to you directly. In the meantime, thank you so much for joining this call.